introduction. I think you briefly mentioned about my profile, so that I won't repeat that in the interest of time. But really, I started my investing journey as a research analyst. At first instance, I was really bored because it was with an internship at Lehman Brothers in London. And I thought that I'll probably never do research ever again in my life. But as luck would have it, I actually spent like next 13, 14 years early in my career actually doing precisely equity research, and that was covering the Indian consumer sector. In the retail sector, I also covered some textile names and some European and global emerging market names as well during that course of time. As of today, I'm representing a firm called Tawaga Advisory, where we are not research analysts, we are SEBI registered investment advisor. So RIA is the license of SEBI that we are holding currently. But that's I'll let Nitin Mangal also explain a little bit about his background, and then we can move further.
Yeah, thanks, Nitin. So yeah, I'm Nitin Mangal. So I'm SEBI registered analyst. So we do provide our research, and our research is mainly covered based on the forensics and accounting juggleries which is being done by the companies. And this is how we educate the investors and tell them the red flags lying in various companies, so that they can safeguard on the amount of investment what they make in the market. Yeah, thank you.
Sure. So before we start, just a usual small disclaimer from our side that this entire presentation is for educational purpose only. It should not constitute as investment advice by any means. And we don't expect you to take any investment decision based on what we are going to hear from us today. If you have any doubts, please consult your advisor or your distributor, whoever you are consulting for your investment needs, essentially. But the attempt here is actually not to negatively implicate or accuse any of the companies or promoters. But the whole idea is that, maybe take some use cases on a very broad 35,000 feet view and see, what are those red flags which can actually be identified, because some of you did mention that you are investing into equities directly, and this is where you have to be really careful about some of the macro things. Now, it cannot be taught in like one session, but hopefully this session will give you enough food for thought when you're looking at the companies and, a lot of those companies which are held by promoters. Now, we individually are running our businesses as well. We have huge respect for promoters. It's just that, this educational session is totally dependent on some of the things that, you need to look very specifically about, how financial scams have happened and some other things. Now, specifically, when we are looking at this session, what we are trying to do is, in a very broad and quick way, we are going to cover that how can you read some financial accounting statements. One very easy to spot red flag is about overstatements of revenues. How can you pick up that? There are some bit on provisioning, enhanced return ratios, capital allocation as well. Probably we are going to skip those sections, in the interest of time. But the next section that we are going to cover is R&D and, how aggressive accounting happens in research and development as well. While specifically one thing which is much talk of the town right now is related party transactions. So we are not going to name any companies, but hopefully, you will get a fair bit of sense about how to go deeper into when, you suddenly look at any of these things, happening from the revenue or from any related party transactions perspective, or anything on the front of aggressive accounting, which is just like borderline financial scam. This could be a gray area in many aspects as well. Having said that, how companies can actually abuse this liberty and then, just make many things, different in the way you read any of the growth metrics or anything, for that particular company. Now, first thing, that we are focused very strongly on now is understanding how revenue recognition works and, how they are actually different for very, very different companies. Importantly, there's one factor of unbilled revenue. Now, I'll let Nitin Mangal explain that, precisely about what unbilled revenue is. But essentially, for revenue recognition, you have to understand a little bit in the format of how the whole thing is like little more complicated than it is actually. So let's say we go in a shop, we buy something, we actually pay for that services. Let's say we buy a shampoo for 100 rupees, we pay that 100 rupees. Now that 100 rupees becomes like the income of the shop owner there straight away, let's say. and we give the money to the shop owner, and that point, this person is like accounting for his revenues, when he's realizing sales from us. But as you flow through the value chain, there are distributors involved, there's like, warehousing charges may be involved as well separately. And then at the end, there are FMCG companies involved, who have actually made those products as well. So revenue recognition actually flows in many different ways for all these players as well. And this is one important, value chain, which is like very, very important, that just by booking up a revenue of 100 rupees at shampoo doesn't mean it's like booked all across the value chain in the whole idea when you're buying any product or so on. And then second, about excess provisioning, how can you identify that some revenues are wrongly billed or not, but there's something called unbilled revenue. Maybe Nitin, you can briefly explain us, what exactly you meant by unbilled revenues here.
Yeah, thanks. So I'll just make it very simple. So unbilled revenue is, whereby like, you understand the IT business and the infrastructure business, whereby you have stage-wise payment to be made to the clients. Now, if companies, so let's say, you have first stage-wise 10% stage, you will make you raise the invoice on the client and client will make a payment to you. After 20%, you again raise the invoice to the client and he'll make a payment. But if you've completed 15% of the work, then for additional 5%, whereby you cannot raise the invoice, still you can recognize the revenue in the books of account. Nothing wrong in recognizing unbilled revenue in books of account. This is a normal practice which happens in most of the IT companies, infrastructure companies. But as a thumb rule, so I'll just, rather than going to nitty-gritty, I'll just say, as a thumb rule in the forensics, what we do is that if in last 5 years, my annual revenue growth is higher than the growth in my total revenue of the company. So let's say my unbilled revenue is growing at 20% rate. However, my revenue is growing only by 10%. Then it gives you sense that the company is aggressively booking its revenue, or there may be something wrong in the financial in the revenue policy of the company. So you have to take these things very seriously. You just don't need to jump on the companies that see the company is showing a revenue growth and it becomes a very good investment decision. No, you have to see that how this number is growing over the years. And in one of the companies, or few cases, we have identified that even company has written off or created the provision on this unbilled revenue. Now just imagine, that you have not billed something to the client. Before billing, the company is aware of that this money is not going to come back to me. So if you are aware of that this money is not going to come back to you, then why you recognize the revenue? You should not have booked the revenue. So like, you go to a shop whereby you're selling a product to a client, and you know that this client is not going to pay me, so that's why I'm not going to deliver the product to him. But if in between that, why you're recognizing the revenue? You don't book the revenue because the transaction is not going to happen. So these are the practices which are being followed by the companies to justify the growth what they're having. They'll achieve over the period of time to seek the higher valuation in the market, so that they can ride on the stock price. They'll get benefited because of the higher market capitalization. They can sell their stake at the later stage. But at the end of the day, we the retail investor who suffers a lot. Yeah. So this is about the brief about the revenue.
One way of thinking about is, why would any company go for aggressive revenue bookings, when probably the cash is not coming or might be coming in later as well in the company. Now, the biggest thing is, sometimes there's excessive market forces, focusing on revenue growth as a single matrix to justify high growth companies. Now, this might actually be true for some of the new generation companies, might be, we are not naming any company here, but where, these promoters are under excessive pressure, to build or to book, very high growth trajectory, so that they can justify the valuations that these companies are running and so on. And this is where, this whole idea of, booking revenues very aggressively comes into picture. And that's where, let's say if you're looking at any revenue growth, I mean, the devil is in the details, you have to look at the quality of revenues as well. And this is the point that we want to make as well, that just because a company is going steadily doesn't mean that it's a bad company as compared to a company which is growing at a hyper growth matrix, which is just too unrealistic or too good to be true. So that's the whole thought process. Nitin, anything on more of these slides? But innovative accounting is something, that is something that you covered very much in brief, about software development in terms of, how IT companies, and I guess a lot of people from IT companies are joining today as well. But, so probably it will be good to know about innovative accounting, which is what a term we'll be using very often. But how do you sort of explain that as well?
So innovative accounting comes in a play, whereby what happens is that when you sell the bundle services, right? So let's take an example, whereby you go and buy three goods or three services, whereby each service is having a standalone price of 100 rupees. Now, if you want to buy all these three, then ideally the price paid should be 300 rupees. But because you are buying all these three at one time, so normally companies do offer you discount. So let's say it will be around 250 rupees what they are going to charge for bundle service, all the bundle goods or services what you're buying. Now, accounting standard is very much clear on that, but there is a small leeway has been given, and which is being used by a lot of companies. And there is why these companies, rather than booking the revenue at 250 rupees, they book revenue at 300 rupees. And this 50 rupees they book, they keep idle under the unbilled revenue. And one fine day, they just write it off or take a provision of that. So on prima facie level, you look at the company revenue is growing, but it is getting accumulated into the unbilled revenue. And one fine day, all these revenue will disappear from the books of account.
That's good. Any other sector, Nitin, where you've seen very aggressive innovative accounting happening? Sector.
It's the infrastructure sector again. So
Yeah.
these accounting policies are very well prominent in these two IT services and infrastructure sector.
Great. So I think that's the whole idea of how do you sort of look at innovative accounting and everything. But again, the whole idea about ideal revenue recognition, the way it should be considered, and this is what we talked about as well, that net of variable considerations, revenue should be highly probable, for the company to get that amount. And that is the whole idea where actually the whole objectivity becomes subjectivity sometimes. It's a CFO's prerogative whether to take that call and say that, okay, this revenue, we have very highly probable that, this is the right build amount and we have to build that. And this will not be reversed in future as well. And those are the factors where even a simple accounting number that we always thought of revenue as it has so many moving parts to it attached. And this is where from a company level company, you have to look at different ways. Other ways, actually, when you can pick up some of those things is by looking at peer group companies as well. Sometimes, the company is growing at much faster pace than the other rest of the industry. And this is where these things can be like looked at, in great detail that, if some industry groups are like in the same domain, how is one company saying that, okay, they are growing at much faster pace than the other ones. And then as you go into details, as we say, devil is in the details, you figure out that there might be some innovative accounting done, some change of accounting done and everything. Now, one of the things which I picked up personally in revenue recognition is by a consumer company which was running more like a beauty clinic, under its umbrella, and they were booking revenues upfront. So what happens is, let's say you take a membership, you pay for 12 months sort of a period, a membership period or something, and the company is booking that as a revenue at that particular spot of time. So let's say if you do and go for membership in January, February, March, and you pay, let's say, for 12 months period, the whole idea is that, the revenues were booked in that period of time and which were captured in that particular fiscal year, while the idea of servicing those revenues and everything was spread out for next 11 months, next 10 months, and next, 9 months, and so on from the next fiscal year perspective. And this is where, some of those small things can make a huge difference, because on the face of it, let's say if there's some aggressive promotion going on in January to March quarter to book more revenues or to book more clients like gym memberships or something around that, this will very, very unfairly, sort of mark your sort of revenues bias towards that fiscal year which is about to end. While the whole idea is if you take a gym membership in January, you will actually spread it out to 12 months, and the obligation will be of the company to service you for the full 12 months, and 9 months of which will actually fall in the next fiscal year. So those are small things, on the revenue recognition accounting side these cannot be really called up as like very strong financial scams or financial frauds. But the whole idea is that, these leeway which are being provided by regulatory bodies, these are sometimes abused by companies precisely to please their shareholders or to meet some short-term objectives and everything. And as a stock market investment analyst or investor, you should be fairly, sort of aware about how these things play out. Right? I think that's enough of revenues now. Maybe, maybe I can skip provisioning, Nitin, unless you say that we should cover it in briefly here.
No, you can skip it. So
yeah. I mean, we can skip it in the interest of time, and if there's more time at the end of this presentation, we can obviously, sort of come back. Now, on continuing on the revenue recognition and excess revenue, right? Anything on the unbilled amounts and the dynamics, the provisions, if it creates doubt, you have to check. If it creates doubt, you have to look at write-offs, you have to look at, peer group, you have to look at, company B in similar domain and so on. And these are the usual checks which you have to carry on and then keep looking at, from how the simple things like revenue recognition are also played upon. But I think maybe you can cover this slide, Nitin, particularly peer-to-peer comparative analysis, about how exactly one should look at if there's a doubt of how revenues are building up, then what is the peer-to-peer comparative analysis that people can use and maybe get some idea about which is aggressive and which is not.
Yeah, so I guess it's always good to compare the company along with the competitor. That how the competition or how the competitive companies present their accounts and how your account is in sync with the industry peer. It becomes very important for that, because if unbilled revenue, like what I said, is very high in the system, so you can cross check with some competitor that whether for the competitor also the unbilled revenue is same. It is the same proportion or not. If you are taking a lot of provision in the books of account, then whether the peer is also taking the write-offs in the books of account, because ideally things move in the same direction in the same sector. It doesn't deviate much. So 10-15% is okay, but it doesn't deviate more than that until unless the company is doing some juggleries in the financial statement. Anything.
Great, thanks. So I think we're going to skip these two sections, but we are probably going to jump more directly into research and development along with aggressive accounting. So this is one line items, which is very important for pharmaceutical companies at least, and even for maybe high tech requirements or defense or some other companies as well, which invest like a lot of money and time in terms of researching and developing, new products. It's actually a very small line item, for consumer sector companies. Definitely not a line item for retail sector, textile sector as such, in their P&L about, how research and development costs are taken care of. But again, companies take undue advantage of, negative capital returns and all those things into R&D factors going as well. Nitin, again, up to you, how do you explain this, really? How can one look at the companies, peer group companies, the growth and everything, in terms of how R&D expenses are being considered, and then, make up a call that whether it's an aggressive accounting approach which the company has taken, or is it like normal to peer group and, something which is like regulated and allowed by regulators?
Yeah, so I guess R&D becomes very important, like as Nitin said, in the pharma companies, chemical companies, then some high-tech companies, because they have to continuously invest into the new technologies. The defense is a new thing in the market, whereby a lot of companies are investing a lot in the technologies, and they do so. Under the accounting standard, you have two options. The research what you're doing, if it is meeting the guidelines that it is going to benefit you in long run, then you capitalize it. Otherwise, you expense it. So it's always interesting to see, especially comparing this company not in local sense, but with the global competitor as well. And how much R&D expenses you have to incur for a sustain, so for a X number of revenue what you are generating. Because this will help you out to understand that whether the company's company operation is sustainable over the long run or not. So there is a first part of that. So you can always compare, because many times it happens. So I'll just tell you example of one of the biggest fraud which has happened in North America. It was a pharmaceutical company, and it was growing tremendously, by way of acquisition. But it was having almost negligible R&D expenses in the books of account. Now, and everybody was, gung ho on that company. The company has stock price has gone up from $25 to $100, $125. But nobody has noticed that this company was not growing because of R&D. This company was growing despite having no R&D expenses. So the business was not sustainable over a long run. It was appealing, it was growing for a short run, but for longer run it was not sustainable. And then company collapsed, and it was one of the biggest fraud which has become the case study in for the many people. So R&D becomes very important part of these kind of companies to see whether these are comparable with industry standards or with the global standards. And again, R&D, so there are a lot of expenses which you expense out in P and income statement, and a lot of expense in few other expenses you capitalize in the books of account as a fixed expense. What is the proportion of that? Because if company want to take near-term benefit, then what they'll do, they'll capitalize higher expenses, and they'll book lesser number of expenses in the income statement, which will artificially boost their margins and return ratios. So you have to be very careful, and I guess you have to compare with the local industry competitors or maybe global competitors to see that what kind of accounting, what kind of mix they have. So like in this example, we have already given this company and the global peer, whereby the mix, if you see 40% to 60%, however, in global, it's 75 to 25%. So there was a huge gap between the expensing of these expenses and capitalization of these expenses. So these things have become very important because it may not result into a big financial scam in short run, but in long run, if companies tend to do the same thing, and if they are spending much lesser amount on the R&D expenses, then their business becomes unsustainable over the long run, and these companies can get into big trouble. Yeah.
Sure. Now, one very important aspect, which you have probably all of us, or who have been reading newspapers, would have noticed something, on related party transactions. Now, this is one of the most common way, in which unfortunately not only Indian but global companies actually get engaged with. They do some related party transactions which are allowed, which are not allowed, and then account it very differently from the time, when it's being reported to the market conditions and so on. Now, what is a related party and how does that transaction work? So very much this pretty much assigned to like promoters' greed, that how things shape up and, how those things will be taken care of. So the promoters have created a company X, let's say here, and then there will be there will be directors and promoters, who will be there in the company, which will be engaged with company X, specifically. But now the problem is that this company X is different from company A, which is where the whole other business activities are happening as well. And the promoters are maybe common, or maybe, they are related parties, they are relatives, they are, something where, there's a huge conflict of interest essentially. And these are the ways where the areas that you should be really careful about, that what are the transactions which are happening in that side of things essentially. What is mandatory is that, companies do have to report some of these related party transactions. And this is where, probably one has to be careful about what exactly is happening. But then what exactly are you looking at, when you're looking at related party transactions in any of these companies?
So normally, historically, when I started my career in 2007, so it was quite evident, that if someone has given loan has given loan to the promoter group entities, it was treated as a red flag. And as you know that, all these financial scam or shenanigans, it evolves over the way of time. And even promoters have find new ways by, hiring the professionals, by hiring chartered accountants who know all these old school of thoughts, that if you give a loan to the promoter company, then market will not like it, investor will raise question on us. So they derive a new way. Nowadays what they do, instead of giving loan, they do enter into normal sale and purchase strategy with these companies. And being the investor, you will say, okay, it's a normal sale purchase transaction. There's nothing wrong in the company. Everything is going smoothly. But actually, nobody has seen the financial statement of the promoter group companies. So in lot many times I have seen, and this is biggest threat or fraud is which is going on in many companies globally or India. So that these promoter group company transaction nobody looks at. And if you look at these company financial, many times you will find out that these companies, promoter group companies, are making exorbitantly high margins. So like I was looking at one company, whereby the margin of those companies were more than 50%, despite the power of being manufacturing first. So this was the ideal, this was the innovative way where they can understand from the company, and you have to pay attention to that. And this is the biggest function scale which is going on.
Sure. So that's the whole idea that, there are these joint ventures which are being created between companies, where one should be careful about. Then these are joint ventures, which are not really marriage of equals, so that's very important that sometimes, random joint ventures are being announced by companies and you suddenly see that this company A's top line is very different than company B's top line. Then how come they are actually entering into a joint venture? What is exactly happening there? What are the promoters who are like getting captured where, and how is company A maybe invested into anything in company B or something around that. So those are the factors that one should actually look at very carefully as well, that maybe if the two companies their top lines are different, and then what is this joint venture all about and who's going to do what, and exactly where is it leading to. Some of the foreign companies actually do enter the country by virtue of joint ventures. So it's not sometimes through that ways as well, that let's say if there's a French company or there's a Spanish company which very niche expertise into some area which Indian companies don't have, then these guys will enter a joint venture and might sort of help the company set up run these businesses as well, and then take it from there. But again, one of the things is just taking it into related party transactions and joint ventures, and some of these things are something to be looked at very carefully whenever you see those things going into any company particularly. So anything on this slide, Nitin, which is worth highlighting?
Yeah, it is the same thing which I highlighted, right? So like if you look at the daily financial, the most of the company, most of the revenue is being generated by the related party dealings, and promoter was able to get its share of pie.
Sorry, your voice, Nitin, your voice is not very clear. Sorry.
So I guess I have a bad thought. So I guess so this is the ideal way, whereby the majority of transaction happens via the listed arm in JV. Promoter is the party who is part of the JV, and this is how the asset has been built, which will eventually benefit the promoter at the cost of the company financials. The company suffer huge loss because of this, because the asset, if company will build up on its own, it will cost them pretty lesser amount.
Sure. So I think maybe we can just end this presentation here. I mean, we can go on and on in terms of how we look at sort of just various different companies. There are millions and trillions of ways in which financial frauds have been happening in the history of civilization. But one important message that we need to leave this presentation is that financial scams are not only a result of individual malpractices, but it's actually a reflection of systemic failures and loopholes. And that is the whole idea around financial frauds, or scams that one should be aware of.